Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today we have on the channel Rob Lozon, CIO of Middlefield, and we're going to talk about Middlefield's new split share fund. Rob, how's it going today?
Yeah, doing very well yourself.
Doing good, thank you. Pretty good.
Yeah.
Always a fun time when one of my personal favorite fund managers releases a new split share fund. So now you guys have three of them, right? You got three split share funds. So the one in question, of course, that we're talking about, and I'm going to share my screen here, is the infrastructure Dividend split Corp. So explain to me a little bit because this is a bit of a unique situation because you actually converted one of your existing closed-end funds into this fund. I believe it was CLP.UN, which my memory serves me right, correct me if I'm wrong, clean energy, and had a lot of infrastructure and utility stocks. So why did you guys decide to do that conversion? Tell me a little bit about the move that you did.
Yeah, it was really to achieve scale.
Okay.
Historically, we've proven with our split shares that we've been able to grow them. So all of the fixed costs in a fund over a larger denominator or a bigger fund, it amortizes the cost down. So it's really bringing the cost down on managing these funds and being able to grow this fund. The structure of a closed-end fund is a lot tougher to grow versus a split share. So we were able to convert essentially a fund with similar attributes into one that's now the surviving fund is infrastructure split, and we launched some preferred shares to match, and
Mhm.
it's been trading on the exchange now for a few weeks.
Yeah, and the stock symbol is IS. So of course, IS is the Class A shares because split share funds have, a split. They have two classes of shares. So IS for the Class A shares and the preferred shares are is.pr.a. So you got to look for that PR if you want to invest in the preferred shares. So let's talk about the stock selection, which is always the first thing I want to see. And you have the fact sheet here. So you actually have the top 10 names, top 10 holdings, a lot of utilities and pipelines and real estate. And I really like this here in your fact sheet. You actually have the sector breakdown. So the majority in utilities and pipelines. So you're making the distinction between utilities and pipelines. So, I'm assuming utilities is more electric generation, pipelines are pipelines. But you also have some communication services, things like Bell. You see that it's one of the holdings there. 20% in real estate, a little bit of industrial. So tell me a little bit about what this fund is all about in terms of stock selection. How do you choose these stocks? What companies and attributes are you looking for this split fund?
Yeah, well, dividends are important. Obviously, we're
Hmm.
paying out, high levels of distribution to our shareholders here that own the fund. So, we earning as much of that distribution as possible is first and foremost. So you're going to see a lot of dividend payers here. We really are looking for companies that fit the bill of what true infrastructure can do. So whether it's utilities, pipelines, digital infrastructure. Um, these companies have pricing power. They have many of their business lines have long life assets with contractual obligations to a counterparty, which also have inflation escalators. So it's really streams of cash flow that are quite predictable across the stocks that we're picking. And as you noted, utilities and pipelines represent about 70% of the fund currently.
Yeah.
And we're not going to turn over the names, drastically. Hopefully, these names we can hold for multiple years, but you'll see some changes in the portfolio from time to time. But the two of those sectors there add up to 70%, and that I view that as energy and power infrastructure, which I think is a very powerful theme right now. The world, ever since that Ukraine invasion by Russia, the world's been has had heightened awareness of energy security, affordability, and at the same time, we're all striving to make the world cleaner. But I think what's really important for people now is the cost of energy and making sure those lights are always on, or the air conditioning or the heat is on. And there was some trepidation around that a few years back that parts of Europe wouldn't be able to heat their homes or businesses wouldn't be able to operate in the winter. So energy security, it has been a major, major talking point. And that's why I think there's a good tailwind here for outsized returns on a sector that still valuations are very reasonable, and that's the utilities and the pipelines. And there's multiple other secular trends that are positive for those two areas that I can get into as we further the conversation. But that's kind of how I got the fund positioned right now, is really an overweight in utilities and pipe.
Yeah, yeah, it makes sense. And like your typical Middlefield, other split funds, these are high conviction names. I know Middlefield is an expert in core competency is real estate. So you got some real estate in here, but another core competency I believe is infrastructure and energy. Um, so yeah, very interesting. I noticed that there's a little bit of United States and international. So 67% geographical allocation. Is there a reason for that? Is that for just added diversification, or do you feel like there's really some nice names also south of the border that, like you said, have great valuations, like Southern, which is right now your top position there?
Yeah, there's areas that I can't get in Canada, and I like
Mm.
getting the dividends out of Canada and the attractive taxability of Canadian dividends. But for example, getting a pure play data center company, I can't get that in Canada. So I've gone down to the States to get the best in class company, Equinix.
Equinix, right?
Southern, yeah, and Southern, like you mentioned, to have some exposure to Georgia and some of these areas in the States that are have exposure to these tailwinds of onshoring, urbanization. So you got people moving to Atlanta. You've got businesses starting there as governments are onshoring and not relying on globalization anymore. And that's an after effect of COVID, and saying, we got to make our own medical supplies here. We got to build our own battery factories here. And then also they're in that line where there's a lot of data centers and being built for obviously the cloud, and now we've got this other acceleration of AI.
Yeah,
And Southern is just put in to power a couple of nuclear plants, which is now people realize how clean burning nuclear is and how long life. Like the reactors that they just brought online should provide power for the next 80 years. So I can't get pure exposure to that in certain parts of the world and in Canada. So, you know, that those are just a couple of examples. But then when I look at Capital Power, this company out of Edmonton is buying up U.S. gas powered facilities, and 3 years ago there was a lot of states that were kind of a little nervous and a little bit on the sidelines of bringing more and more natural gas powered generation. But now they've all realized that what natural gas is doing, one, is baseload power. So if they want their electric vehicle charged, if they want their iPhone always charged, and if they
right.
want these data centers and AI chips fully operational, you need baseload power. And the cleanest way to do it is nuclear and natural gas, because the third is coal. So if you
Yeah.
can displace coal with cleaner burning natural gas and nuclear, that's a win for the environment, and you're still getting secure. In the U.S. and Canada has lots of natural gas, so we have the ability to be self-sustained, and we've got lots of uranium here in North America, so we can be self-sustained on nuclear and natural gas, and we're not a net importer. So that's a very secure way to generate the power. And Capital Power has expertise in generating power with gas-fired facilities. So that's a stock that's starting to break out, and we've added it a few weeks ago to this portfolio, and it's done quite well. TC Energy, another
Hmm.
stock, is splitting into two companies, but the
Yeah.
RemainCo is going to again be a pure play on natural gas and nuclear. So I think you've got a little sense there of what I've talked about of trends that I like. And again, these companies pay high levels of dividends. They're growing their dividends, which helps me fund my distribution to unit holders, and gives me a secular trend of growth in infrastructure. And we're going back to it's dull, boring infrastructure, but sometimes dull, boring companies like this with growth are a good ballast to use in your portfolio, because everyone's got their growth stocks, but I've got income and growth stocks in this portfolio.
Yeah, yeah, for sure. I agree with everything you said. So I heard lots of great things. First of all, the major thing is you're very aware of these companies, what they're doing, what their plans are. Obviously, these are, I would say, great investments for the long term. These are not short term companies, they're long term. Everyone needs their energy, right? Technology, data centers. I like that there's a little bit of diversification within the real estate. Yeah, you have RioCan, right? But you also have Equinix, which is, infrastructure for data centers. So and like you mentioned, a lot of these sectors, they don't get much attention, but they actually have, the companies themselves have very, very high levels of dividend. of dividends. And we kind of discussed this last time, but I just want to ask you again, do you think rate cuts, which already started happening in Canada, typically help utilities and pipeline companies? And I believe, last time we discussed Enbridge, which is one of the holdings here at 5% at the bottom. Do you think that's also could be a tailwind for these companies?
Yeah, and I think it's fund flows and valuation multiples. So I think what's going to happen over the next 2 years
Hmm.
is we just started the easing cycle in Canada. And essentially, we all went through it here in Canada where, we had overnight rates spike from, call it 1% to 5% quite quickly. And about half of that is going to get unwound. So I suspect you're going to have an overnight rate about 2 years from now with a 3% handle on it. We're not going back to 1% as far, I think the economy is doing well. I think we're in for a soft landing. There's no need to cut rates back to 1%, notwithstanding some sort of black swan event that none of us can predict, another pandemic or something like that.
Right.
But if we get that overnight rate from 5 down to 3 over 2 years, and we just had our first quarter point from 5 to 4 and 3/4 here in Canada.
Yeah, just started.
I can be patient with that. But as that happens, all the money on the sidelines with retirees and investors that for the first time have been able to buy a cashable GIC for 5% or a HISA for 5%. That's great. And all the power to them. And I'm happy finally savers have been able to save.
Yeah.
But over the next 2 years, those rates are going down to 3%, which isn't one, but if TC Energy and RioCan are paying 6 and 7% yields and increasing their dividend, the disparity is going to grow where there's going to be an awareness of I got to get back into dividend paying stocks. So the fund flows over the next 2 years, trickle, gradual, quarter by quarter, be patient, is going to come out of those GICs and cashables. Some of it may go into bonds, but many of them are going to go into BCE, Capital Power, RioCan, and obviously that should increase the share price as demand for those shares go up. And that's what this basket of infrastructure names in this portfolio, I think, is another tailwind for why this portfolio should perform over the next couple of years. And there's 10 names on our fact sheet here.
Yeah.
My goal is to have 15 to 20 in the portfolio. So when we publish our semi-annual report end of June, which will be out late summer, you'll see the full portfolio, and we'll update the fact sheet from time to time. But right now, we just wanted to get out. The fund's quite new, at least 10 of the holdings or 10 top holdings to give everybody a flavor of the fund.
Yeah, yeah, makes perfect sense. And you got some distribution rates here. So the approximate yield right now on the Class A shares is actually hovering around the 11% mark, which is quite high. And the preferred shares are also about 7, which is quite attractive. And we're not going to get into how the split share fund is, all the all the details around that. But these are pretty high rates in terms of distribution rates for sure. And the Class A shares, that's a monthly distribution. The preferred share is a quarterly distribution. So another thing I noticed right off the bat here is that the Class A shares are trading at a significant discount right now. So you actually have the net asset value here of the Class A share, which is literally the intrinsic value, how much it's really worth per share. But then you have the market price. So the NAV is 1487. This is of course based on June 10th. 1487, so it's worth 1487 a share, but you could buy it for 1338. That's pretty much a 10% discount. So this is even a great opportunity. It's even more reason to invest in this fund. Why do you think it's trading at such a discount right now? Is it simply because it's a newer fund? Is it simply because it's undervalued, by nature? What are your thoughts on that?
Yeah, I think it's your first point there. It's a newer fund. There's not total awareness of the fund even existing currently. I think once we just put our fact sheet up, we're able to start talking about the fund. Once I prove that the fund is doing what it said it's going to do and pay its first preferred
Yeah,
dividend, start paying the monthlies, and people realize, okay, there's scale. This thing's, 100 million market cap plus, so that it's got liquidity. And there's a bit of churn from people that own CLP and now have this, and they have to decide, am I going to buy more, sell more? And there's
yeah,
always a new shiny thing that an investment advisor is trying to sell them. So maybe they sold it. Well, you can look at, I'm an insider on the fund, I'm the portfolio manager. You can look at my transactions. I bought, when we IPO'd it, I bought more in the market a few weeks ago, and that's public information down at these levels at a discount, because I think I know what I own. I'd love to buy Enbridge, TransCanada, RioCan, at a cheaper valuation than the stocks are actually trading. And I'm patient. I want to wait for those rate decreases to happen over the next couple of years and compound my dividends. And really, that's what I'm after, is just my total return first and foremost. In my mind is, coming from the dividends. And if I can, we can pick some good companies here and they grow over time, I think there's a compelling investment case here.
Well, of course, it's like buying a dollar for 90 cents. I mean, it's
Correct.
literally as simple as that. And so this is a split share fund. So of course, it's going to have the same rule like most of the other ones. Correct me if I'm wrong. The unit NAV has to be over $15 for the distribution to be paid out. Right now, the unit NAV is hovering almost at $25. So we're really way beyond that point. So plus, I would say it's the defensive nature of this sector. I mean, the high dividends of the companies inside of it. I really think that the Class A share distribution will be, this is my opinion here, very, very predictably stable and consistent. My opinion, of course. But yeah, I mean, to my audience watching, I mean, I think if you're in the market, if you're looking for something that has a nice yield, that has some good dividend paying stocks inside of it, and you want to get a good deal, you like a good deal, this is a fantastic time to get in IS, in the Class A shares, especially because they're actually trading at a nice discount right now. I remember seeing or remembering the same thing happened for RS, your real estate split share fund. When it came out, it was trading at a discount, and I didn't really understand why. And I was buying it at that time, and then now all of a sudden it's trading at a premium. So again, this is just a great time to get into this new split share fund, my opinion. If you like those stocks, you like the utilities and pipelines, it's a fantastic time. So, Rob, I think we covered everything. I mean, I don't have any further questions. I mean, everyone should know what these stocks are. I love the diversification. You have a little bit of US in there as well. There's a bit of real estate to do with not only, like RioCan, but also with the data center. So I really honestly like the composition of this fund a lot. And it's a great way to get really nice high yield of approximately 11% now, which is fantastic. So unless there's anything to add, you have anything to add, Rob, or I forgot, go ahead. Now's the time. But I think we pretty much covered everything here.
Yeah, just think of it as diversified infrastructure, and the prospectus lays out the sectors I'll be investing in, and the subsectors of infrastructure, and
Mhm.
you can see that in the pie chart there. And just stay tuned on our website. You'll see us put fact sheets up and more
Yeah.
information as time goes on.
Yeah, here's the homepage, and the prospectuses are here. I'll put the link in the video description below, guys, in case you want to check out this fund further. If you want to go to check out the NAVs, which I definitely have this bookmarked, I'll also put this URL here where you could see the NAVs, the net asset values updated, I believe on a daily basis, right, Rob? So this
Correct.
is fantastic for the split share funds. You can see if they're trading at a premium or at a discount, and you can make your decision there. So great time to pick it up. So Rob, thanks again for taking the time coming on the channel. Hope to have you back again, and looking forward to the new Middlefield products as they come out.
Yeah, great to be here. Thanks for having me, Adriano.